Imagine turning just $50 every single week into a portfolio worth a staggering $1 million. Sounds like a distant dream, right? What if I told you it's not only possible, but an incredibly simple strategy accessible to virtually anyone? Get ready to unlock this financial transformation. Many believe building significant wealth demands huge sums or complex day trading. They're mistaken. The real power lies in consistent small contributions harnessed by the incredible force of compound interest. Let's break down $50 a week. Over a year, that's $2,600. It seems minimal alone, but consistently investing this year after year, allowing earnings to generate further earnings, creates magic. This isn't just saving, it's putting your money to work, multiplying exponentially. Think of it like a snowball rolling downhill. Gather more snow, growing larger. The longer it rolls, the bigger, faster it gets. This principle, the bedrock of our million-dollar strategy, isn't about finding the next big stock. It's patiently feeding your financial future. This steady approach builds robust wealth, resistant to fluctuations, ensuring long-term success. Regularity is your greatest asset, more valuable than fleeting market trends. So, where do we put this $50 a week? Our chosen vehicle, the Exchange Traded Fund, or ETF. What is an ETF? Simply, it's a basket of investments, stocks, bonds, commodities, trading on an exchange like a single stock. Unlike mutual funds priced once daily, ETFs trade throughout the day, offering flexibility. But their real power for our strategy comes from key advantages. First, diversification. Buying an ETF means owning tiny pieces of many companies. An S&P 500 ETF holds shares in 500 largest U.S. companies. Instant diversification significantly reduces risk versus picking individual stocks. If one struggles, its portfolio impact is minimal. Second, low costs. ETFs typically have very low expense ratios, meaning more of your money stays invested, compounding for you. This is crucial long-term. Third, accessibility. You can buy fractional shares of many ETFs, making that $50 weekly investment highly effective. Even if a single share costs hundreds, you're not locked out by high price points. ETFs simplify investing, making it accessible, efficient for building long-term wealth, particularly for consistent, smaller contributions and broad market exposure without complex active management. They are smart, cost-effective, allowing participation in market growth without becoming a stock-picking expert. Not all ETFs are equal, but for this strategy, we want broad market exposure and consistent growth. Focus on ETFs tracking major indices like the S&P 500 or total U.S. stock market. Excellent examples include VOO tracking the S&P 500 or ITOT for the total U.S. market. For international diversification, consider VT covering the global stock market. These are passively managed funds. They simply replicate their underlying index, not trying to beat it. This passive approach explains their lower expense ratios. When selecting, always check the expense ratio. Anything below 0.10% is excellent. Also, look at assets under management and trading volume for liquidity. While past performance isn't a future guarantee, historically these broad market index funds delivered impressive average annual returns, often 8 to 10% long-term. This is the engine driving your $50 weekly contributions toward that $1 million goal. Focus on consistent broad market exposure, not predicting sectoral performance. By choosing diversified, low-cost options, you're essentially betting on the long-term growth of the global economy, a proven winning strategy. Resist chasing flashy, volatile, specialized funds promising quick returns. Steady, diversified growth is the hallmark of enduring wealth. Your objective: robust, predictable performance over decades, leveraging the broad market's inherent upward bias. Now, let's get into actionable steps. This isn't theoretical, it's practical. First, you need a brokerage account. Reputable options: Fidelity, Charles Schwab, Vanguard, M1 Finance, Robinhood. Many offer commission-free ETF trading and fractional shares. Link your bank account for easy transfers. Remember, the bank here is a physical commercial financial building, typically with visible signage, entrance doors, an ATM, security cameras, professional branding, and concrete pavement, representing your fund's origin. We're moving money from low-earning savings into an investment vehicle for growth. Next, set up an automatic $50 weekly transfer from your bank account to your brokerage. This is critical for consistency and dollar cost averaging. Dollar cost averaging means investing a fixed amount regularly, regardless of market fluctuations. When prices are high, $50 buys fewer shares. When low, it buys more. Over time, this averages your purchase price, reducing risk of timing the market. Finally, enable dividend reinvestment. ETFs pay dividends. Instead of cash, automatically reinvest them to buy more ETF shares. This supercharges compounding as reinvested dividends generate their own dividends and appreciation. This automated, hands-off approach eliminates emotional decision-making, ensuring your strategy stays on track, investing effortlessly toward your $1 million target. Discipline is your greatest ally. Automation frees you from constant market watching. Building wealth over decades involves psychology and discipline. The biggest pitfall? Emotional investing. When the market inevitably dips, fear strikes, tempting you to sell. This is precisely the wrong move. Market corrections and bear markets are temporary. They're also opportunities. Your $50 weekly contribution during a downturn buys more shares at lower prices, supercharging recovery when the market rebounds. Think of it as a sale. You wouldn't stop buying groceries on sale, right? So why stop investing when investments are cheaper? Another common mistake, chasing performance. Hot sectors or trendy stocks might dominate headlines, tempting you from diversified low-cost ETFs. Resist this. Studies show most active managers fail to beat benchmark indices long-term, especially after fees. Stick to your plan. The strategy's power lies in its simplicity and consistency over a very long horizon. This isn't a get-rich-quick scheme. It's a get-rich-slowly, steadily, surely strategy. Patience is your most powerful virtue. The market rewards those who stay invested, weather storms, and consistently contribute. Your long-term vision must supersede short-term market noise. Discipline to maintain course through various market cycles differentiates successful long-term investors. Remember, the journey to $1 million is a marathon, not a sprint. Every consistent step matters, especially during volatile times. Your steadfast commitment capitalizes on every market opportunity. Let's put it all together. Investing $50 a week or $2,600 annually into a diversified low-cost S&P 500 index ETF, assuming 8 to 10% average annual return, can realistically transform into $1 million portfolio over 30 to 35 years. For instance, at 8% average return, $2,600 invested annually becomes over $400,000 in 30 years, and over $900,000 in 35 years. At 10%, you hit $1 million much sooner. This isn't speculation, it's the proven math of compounding with market averages. The strategy's beauty is its accessibility. You don't need to be a finance guru or have a massive income. You need discipline, patience, and commitment to consistently invest that $50 weekly. Start today. Time is the most powerful variable. The sooner you begin, the more time compounding works its magic. Don't underestimate the profound impact of small, consistent actions over an extended period. This strategy isn't just about accumulating money. It's about building financial freedom, securing your future, and achieving peace of mind through methodical wealth creation. Your future self will profoundly thank you for starting this disciplined journey today, transforming a seemingly small weekly commitment into a life-changing financial legacy. If you're serious about maximizing investment growth and optimizing your tax strategy alongside this powerful ETF approach, then you absolutely need to watch my video breaking down the benefits of a Roth IRA. It's the perfect complement, supercharging your tax-free growth toward that $1 million goal. Click the link on screen or in the description to watch it next and accelerate your